Hello everyone, today is January 21st and this is our third session of the Waikif Trading course. Thank you for all of your emails and for all of the comments that I've received about the first two classes. You could see some of the comments from students on the left side of the slide. I'm really excited that I hear a lot of excitement from you guys, and that obviously always energizes me, to go on and to think that this is going to be a great cycle. And I see how you guys are communicating with me. It took me a few hours to go through the homeworks. So I've actually was able, today, and usually Monday is my preparation day for the course since the morning. To go through all of the emails, and there were quite a few. So thank you for sending those. Thank you for all of the kind words, by the way, that you sent me, about the course and, the knowledge that we present in this course. So I really appreciate that. I am also was somewhat impressed because the first homework where people send me their labeling kind of gives me an understanding of what the cycle is going to be, and how people are going to be in this course, and so on and so forth. So I was really impressed with the level of understanding of the material. That's number one. Secondly, how you guys are picking up the new knowledge and applying this. Having said this, there are obviously tons of adjustments that we will do, that we will need to do. So, this is not a finished product yet by any means. So there is a lot of work in front of us, but still such a great start. And today, specifically with the homework, I want to point your attention to the identification of phase boundaries. Almost in each of the homeworks, we had something to adjust around the boundaries of the phases. And obviously, there's something that I need to give you. So we will definitely go through some of the theoretical material where I will show you how to identify phase C, how to identify the boundaries, between different phases and so on and so forth. And then, we'll go through all the stuff today as well. Next session is January 28th. We are going to continue with the price structure. So these homeworks are fundamental tools for us to start learning about phase analysis. So that's going to be our focus, and we will continue with that on January 28th. All right, as usual, all of our classes are for educational purposes only. Stop your video, read the disclaimer. And then today, actually, let me do one thing, guys, before I'm realizing that actually slightly unprepared. Do you guys see my screen right now? Okay, yeah, you should not be seeing my screen right now. I think, okay. Okay, great. Hold on a second. Okay, awesome. Okay, great. And now we should be back. All right, yes. So we are on the question from Lee. Okay, awesome. Thank you, guys. It's just like one minor technical detail that I had to take care of. So this is a question from the student in this class. Why am I posting this slide here, and why are we discussing this question? I usually email you guys the instructions about the questions as such. If you send me a question that requires a lot of explanation, most likely I will not be able to answer it over the email. But I really, really would like to answer this email in the classroom environment. And there is a specific reason of why I want to do this. If I am spending time answering your email question, and let's say I spent maybe like 20 minutes on that, let's just suppose that this is a big question, then what I'm not doing is I'm not explaining the same concepts to other people in the classroom. So what is the best to do is to have the question that is in line with the content that we are covering right now. So Lee is sending the question that is very close, it's a little bit on the borderline here because we're going to discuss, some supply and demand, but I think it's a really good preview for our second month when we will be diving into the supply and demand concepts. Plus, Lee is taking the chart from our class. This is the chart of Yahoo. So questions like this, sometimes I will subjectively put into the content of the class. We also will have one session, the last session will all be devoted to Q&A. And I know that you have so many questions about the homework right now. We will go through those as well. And usually homework questions, those that definitely need to be addressed during the next class, with the homework review. So we've talked about Yahoo, and we were talking about Yahoo in the context of a change of character. This was the first place where in the trend we saw how the change of character has happened. A much larger reaction to the downside. There is not a lot of supply that's coming in. It's kind of flat, I would even say. But the result to the downside has increased, even though supply has not increased. So what can we conclude? Well, we're still thinking that this could lead to a change of character and therefore a trading range. And then we need to understand what kind of bias we're going to have in that trading range. As I mentioned to you in the previous class, and this is the way how I establish my communication, and kind of like my integrity with you guys. Even here at these two spots, I'm thinking that the bias is still to the upside. I'm not sure if anybody could persuade me otherwise at this point of time. I just don't see any increase in the volume signature, maybe slightly more here, but the result is even less than the first change of character. Less supply on the next reaction, only really 1 day of selling and then just, inactivity by sellers and more deterioration of the volume and the supply. So we still would be thinking that the bias is up here. And our position is going to be here. I mentioned that probably we would be closing somewhere here on this bar. And this is how we come back into this trading range. So, and then the question is about two spots, or two bars, or rather, two places, number one and number two. So we already see how the price has deteriorated below two levels of the support that were so important. One of them was in the middle of the range and was still, please note, the bias was still to the upside. So now at the failure of this, we have a couple of failures actually. So the first one comes as an upthrust, and there is the first failure. The price comes back into the range. So at this spot, we're always thinking, a sign of strength rally or an upthrust situation. And we'll talk about this more. As the price comes back into the trading range, that becomes a failure, and therefore we start talking about the upthrust. An upthrust could be a function, could be a part of the reaccumulation, that's true, but also an upthrust, could be a part of the distribution. So the next thing that we do after the failure is we want to see where the price will go, what kind of price deterioration we will have, and what kind of character behind this deterioration we're going to see. So we're seeing that the price is committing below local support, and by itself, it's a weakness, at least a short-term weakness for now. And then we see the increase in the effort behind the increase in the supply. So that suggests to us that there is some kind of short-term bearish bias that we should be aware of at this point. The rally, which is going to be an LPSY rally here in the middle of the range, is very weak. It doesn't even come to 1/2 of the move to the downside that we've seen since the upthrust. So again, more weakness, and then a continuation of that weakness, and a slight commitment even below the previous support line. So we are in a sign of weakness type of environment. Supply is increasing, And as we go into those two spots, number 1 and number 2, we are creating the new trading range that already has some bias that we perceive at this point as the downside bias. Why is that? Well, we've seen a change of character. This is the largest reaction to the downside than what we've seen before. And now we are trying to confirm that change of character. How are we confirming that? Well, we need to have a rally, LPSY rally, last point of supply rally, that will fail at some point. At which point would it fail? Well, we want for the distribution this rally to be so weak that it cannot overcome 1/2 of the trading range, or the height of the trading range. And we kind of see it here, right? So the price goes up with enthusiasm to the upside and comes to this value zone right here. And what do we have here? Acceptance of this level or rejection of this level? Supply coming in at the highs of this resistance, or supply is coming in and being absorbed, or supply is not coming in? Well, we definitely see that there are some spots, for instance, like right here, where first of all, after the short-term break of a trend, we see that supply is actually increasing. And this, I wonder if, Lee, you have seen this, spread and this increase in the spread as well, because it's all related to the other two that you've mentioned here. Actually, another one right here. So let's kind of observe what is happening at these spots. The first one, the second one, third one, and then the fourth one. Actually, we could even do this. We could even look at this and this. So one of the things that we notice right away is we want to notice the areas where supply has come and supply has increased, and it's started producing either a stopping action, some kind of reversal action, and then synchronicity with the increasing result to the downside. And that's kind of like a sequence of how supply is going to come in. Supply is not necessarily right away it's going to reverse the whole bias. It's just impossible, because it was the uptrend that we have had. There is a specific sentiment that exists in market participants' minds at this point of time as to what should happen. We should be in the uptrend. We see this from the sentiment we could derive from how the price moves and from the volume signature. Everybody is on board. Nobody is getting out of this position. The first time when we could see a more meaningful getting out of this position is going to be in this area right here. And this is why until then we're still thinking that we might be in the reaccumulation, because the texture for both the price and the volume is such that it dictates that the price most likely is going to continue to the upside. Now, as it continues to the upside, this is where for the first time we're experiencing some increase of the supply. And for the first time, it's not only stopping the price from moving further up, but it actually synchronized with the result to the downside. So this is the first area of significant institutional selling that we see. Now, as we go through the sign of weakness, then we see how supply also comes at the lower level. So we are kind of now in a different value zone. And this value zone, because we're looking at the distribution, is going to be described as the value zone for weak hands. This is just a definition of the Wyckoff trading course that I created, for you guys and for myself. This is how we would define the value zone. So what is happening here? And coming back to this question by Lee, I would like to understand what was actually happening at points number 1 and 2. To understand what's happening at these 2 points, we need to understand what happened prior, and we kind of go into this. So the value zone for weak hands, what does it mean? It means that at this spot right here and at this spot right here, weak hands are buyers. And if they are buyers, what do they see? The weak hands are seeing some kind of value. So that's a very interesting thought. How could they see value at this point of time? The trend up has been broken. The stock went into the consolidation. The stock is at the support level. Wouldn't they feel more fear to come in and to establish this position? It's a very interesting observation about the weak hands, because the weak hands are going to be getting into the trend either very, very late, and they will be profitable. So weak hands getting in, and they will be profitable at this point of time. And then this is going to be the first group of weak hands. The second group of weak hands is going to be somebody who, someone who maybe sold this stock and did not participate. That's number one. Secondly, maybe sold the stock, did not participated, but then got out. And then as the price goes into the consolidation, and especially goes back and produces some kind of move to the downside within the confines of the structure. So this is the structure that we would be looking at the time. The weak hands are going to see some value, and they're going to say, this was a leadership stock, and I didn't really participate, or I didn't participate in this whole trend, but now that we are at the support, this is where I'm going to come in and I'm going to buy. And that's how they see that value at this spot. They're coming in and they're buying, and because they don't have a lot of strength behind it, the rally that is being produced is not that great. And what else is happening, even more importantly, is that into the strength of weak hands at this point, when they see that value, institutions are going to sell into that strength. So, and we are seeing this later on in the selling where supply is increasing, on increased volume signature, and on increased down spread. Look at this spread right here. This is the largest spread in this whole rally. It just tells us that the rally is done, and once the rally is done, you instantly know that this is the high of the rally. And then you start making your assessment and deductions as to what kind of effect was it in the relationship to the whole formation, to the height of this formation. And you see that it's only 1/2 of the range that this rally has traveled, and then it met so much supply, so much selling. Okay, well, then we go back into the same area. Again, weak hands, thinking that this is the new attempt to go up that is going to result in the overcoming of the long-term resistance. And what do we see as we come to the same resistance point? We're seeing how supply is still increasing locally, and not only that, the downward result is increasing as well. So that becomes a reversal again. And you start questioning, we've done this 2 times already. And every time that we've come to this level, what happens? Some institutions are selling at the resistance point. So what is their bias? Their bias is to the downside if they're selling, right? We see that from the increased volume signature. Only, usually big institutions will produce this type of signature. So therefore, we are thinking about confirmation of this bias. And as we go down on the next reaction, we're seeing a sign of weakness. The price commits below. Yes, it comes back, so there is a sprint type of action. But we know that there was selling here, inability to overcome 1/2 of the height of the range, and then a sign of weakness. So this could be just temporary. And we could be just somewhere still in phase B at this point of this whole range. So what do we see next? We see the next attempt, and this is where we're coming in into 1 and 2, those 2 points. And let's see what happens. This is the highest volume signature on this bar, and this is probably just some kind of event. And there is a lot of optimism on this bar. Again, we could see this from the volume signature, and we could see this from the price signature. This is most likely, and this is a weekly chart, this is most likely some kind of earnings and so on and so forth. And the biggest question that actually Lee is asking here, somewhere in the description, he's saying that so much movement to the upside, so much effort, yet what do we do? What is the final result? And to understand the final result, we need to understand the original intent or intention behind this move. If there is so much enthusiasm behind it, the intention was to overcome the previous points of resistance that we were not able to overcome. And then what do we do with all of this enthusiasm that is even more than what we've seen before? We can't even go to the same level. So what looks this something, this move to the upside with so much strength and optimism, looking so bullish at this point, is actually showing us an ability to repeat the same bullish activity that we've seen before on the previous rallies. Is this bullish or bearish? Why didn't it reach resistance? Maybe this is the correct question to ask. Why didn't it reach resistance? What do you guys think? Well, my thought here is that it didn't reach resistance because someone was selling into the strength. And if you think about the tactics of the CO here at this spot, right, at the point of the resistance, they are selling into the strength of weak hands twice already. And now they are selling for the third time at the lower level. So this means automatically that the bias is still being confirmed as the downward bias, and that now the value zone is slightly lower than what we've seen before. So when point number 2 comes, which seems like a very logical diminishing volume signature, so we might be thinking that, okay, supply is diminishing here, which is correct as well. But what's not happening is that we're not going anywhere with all of this increase of what seems to kind of like an amateur eye, a bullish scenario. There is still an attempt to go up, and yet we can't reach even the previous level. So again, we're just confirming the bias to the downside at this point of time, and we are interpreting the increase of the volume signature as still not necessarily a still increase of the supply over average supply. And then we see that supply is diminishing over point number 1, and that tells us a different story. It takes less of the supply to produce more bearish result. And by more bearish result, I mean inability of the price to actually create, even the same, to touch the same resistance or create a higher high. So it's a more bearish result on less supply. What does it tell us? It tells us that we don't need so much supply anymore to push the price down. And at this point of time, demand is so exhausted that all of the next rallies are not going to be that big. And we see it with the next rally, and we're seeing how supply is diminishing even more, and yet result to the downside is increasing even more. So this tells us that there is a poor demand and diminishing supply signature on the background where the price is moving to the downside. And that is ease of movement. On diminishing supply signature, we are able to move the price down. Ease of movement. And that gives us a timing to initiate the position. Why? Well, because again, demand is so poor, we know that demand is not a factor anymore. And even though supply goes down, the price still goes down. So we're just going to capitulate at some point. And we're usually going to capitulate around the point of support. So here's that final institutional capitulation. It doesn't have a lot of supply signature behind it. So that just tells us that most likely we're going to stop soon. We're not going to continue for a long time to the downside. All right. Well, Lee, hopefully this is a good explanation for you and for everyone. So really good question. This is not necessarily the question that I was expecting at this point, but I'm really encouraged by the the questions that are coming, and I'm really happy that we're starting with this. By the way, guys, today's class is going to go until 6. We have a lot of material, so I'm kind of already for the next probably 5 sessions. We're going to go up to 6 o'clock, unless I have some kind of appointments arrangements after this. Lots of material, so we're going to cover a lot today. Questions. What about effect in the result if we see accumulation at the right side from 2002, May to September of 2003, only 1 year accumulating, 2003 to 2005, an uptrend, not a powerful effort in an accumulation. Okay. Okay, so let me just, again, to understand this question. So what's the question, Eric? Okay, so this, 2005, and this. Yeah, I'm not sure if I understand the question, Eric. Let's just kind of rephrase it. Let's just think about this. Okay, meanwhile, small time accumulated. You mean this area right here as a cause? Or this as a cause? Okay. So, well, we could definitely apply something like, PNF, try to see what kind of, objective we're going to see here. We could see if this could match this objective as well. At this point of time, we're not talking about the PNF. I'm going to give you some references, but, for those of you who are not familiar, with PNF, please go to our website. There are a couple of things that you could do on the YouTube channel. The YouTube channel has 2 videos right now by Bruce on PNF. Those are basic videos. So go there, and then after that, go to our website, waikofanalytics.com, and there on demand products, you could find part 1 and part 2 of the 2 courses that we conducted together with Bruce on the PNF. So I would recommend just that path. Okay, great. Let's move on, and let's just go through the material for today. So today, what are we going to discuss today? This is going to be the major work for us today, to go through the Home Depot homework review. There will be a lot of questions that I will answer. This is the first, well, not the first time, but this is the time where I'm expecting a lot of volunteers. We are going to put on the chart, and we're just going to go through your logic, and then we're going to start adjusting that logic as to how we're reviewing the chart, how are we identifying specific events, how we're thinking about labeling, and then how do we think about the tactics, and where would we be thinking about opening the position, and so on and so forth. So this might take even 2 sessions, but we will do this. As we go through the review, I'm going to, after each of the slide, each of the exercise, we're going to have some kind of theoretical material. And the main thing that I want you guys to think about, and this is what I see in your homeworks, is the phase boundaries. That's number one. Secondly, phase C identification, and then everything else, we'll definitely cover everything else. If we have time, we will talk about the distribution. If we don't have time, I'm going to give you that homework on the distribution. I'm going to give you the slides on the distribution. Your homework will be to read those slides through, to understand all of the Wyckoff events in the distribution, to know the characteristics of those events, and then apply them to the homework. And then we're going to do the review, the same review as we've done with with Home Depot. Most likely, maybe not in session number 4, but maybe session number 5. So that's going to be the plan for today. All right, with that, let's start our homework. And I need a volunteer. So say yes, and I'm going to unmute you. And let's see how that's going to go. Okay. Let's go to Rami. Rami, am I pronouncing your name correctly?
Rama is fine.
Rama. Okay, Rama. Almost like Roma. Like my name is Roma, actually.
Right.
My short name, so Rama. That's very close. Okay, great.
Yeah.
All right, so let's look. We have 3 trading ranges. By the way, guys, if you haven't noticed, some of you have not noticed, there is another one that I kind of, wanted you to identify. And by the way, Rama, before we start doing this, let me, guys, show you really quickly something that could be helpful to everyone. So I thought that this idea of having homework slides as a separate file, that was a suggestion by one of you. I really appreciate this because I think it saved a lot of time for a lot of you guys. And I know how difficult it is to do the first homework, especially if you haven't worked with, power charting, power charting, with PowerPoints, with PDFs and so on and so forth. But I was really pleased to see that everybody is just kind of like getting a handle on that. So I want to show you a little bit of what I do with power charting, and it will be really quick. So when you receive a slide from me like this in PowerPoint, why am I saying power charting? In PowerPoint, you have multiple options. Here, for instance, under the first, so you're going to be a Home tab, and then look at all of these small icons right here. So for instance, I could click this icon right here, and I could create any type of text that I want. I could move this text and put it, anywhere I want. So for instance, something like this. I'm looking at the upthrust, and I'm saying this is an upthrust. You can copy that. You could create the new one. You could change the color of it, whatever you guys want to do. Then you have, any type of lines that you want to create. You can copy them, paste them. Here's your trend. What else? Phases. So I like to do this for phases, just to identify where phase is, and then change maybe like the weight, and maybe even change the way how it looks, and just say, okay, here is maybe like phase A somewhere here, right? And then just write it down here, and I could change the size of it, and so on and so forth. So there are quite a few useful things that you could do here with the PowerPoint, and it's actually quite easy once you get a handle on all of those things. So let's just practice. Let's just kind of like go with this, with next homework, and hopefully it will be easier for you guys to use it. All right. Having said this, Rama, let's come back to you, and let's look at trading range number 1.
Okay.
So it's this one right here. So one of the earliest question in labeling that I ask students is, I want them to understand that when you look at the historical chart, historical chart, you know already what the bias of the trading range is. And at this point in the course, this is exactly what I want you to do. I want your minds not to think about the bias first. I want you to understand that we have been in the accumulation and that you need to label accumulation correctly. This is the first task. As we progress to month number 2, that's when I'm going to start closing off the chart and then moving to the right and unfolding the chart and as like swings or bars occurs. And then you will have to analyze the bias and the timing and so on and so forth. But for now, this is what we do. We know that this is an accumulation. So in accumulation, the biggest question that I have on labeling, what catches your eye, Rama, that is so distinctively different than anything else that you could identify right away?
The arrest of the descent of the price downwards, the arrest of the downward movement of the price,
Okay, so what about it?
and the price failing to go below that particular level, and rising from that level onwards, defining the level of support.
Okay, well, let's take that thought and let's just kind of develop this. So we were in the downtrend, and
Yeah.
then we stopped that downtrend at this spot right here. And then after that, we went into the non-consolidating environment. We've talked about this in the last session. So what is this stop in action? How would we call it? How would Wyckoff call this event?
Selling climax.
Okay, sell-in climax, SC. Are there characteristics of the selling climax that we could identify here to confirm that indeed this was a selling climax?
The range of the price bars, in other words, the spread, is wide, and there are multiple such bars, and which essentially indicates to me that the momentum to the downside, and
does it look panicky? Does it look like
right,
somebody wants to get rid
right,
of their stocks right away?
absolutely, yeah,
So there is some kind of climactic run
right,
that we are observing. Okay,
okay,
great.
yeah,
We know that, from in hindsight that the price has stopped here. This is the first spot, so usually it's going to be associated with that climactic action, with the selling climax. Okay, if this is a selling climax, then the next rally is going to be what?
automatic rally
And then the next low is going to be what?
would be a secondary test,
And that would conclude which phase?
phase A.
And the intention behind phase A is what?
The intention is to stop the downward movement and then the beginning of potential trading range.
Excellent. How else would we be interpreting or calling this automatic rally and the subsequent secondary test that is a successful secondary test?
The secondary test and the automatic rally would have volume signatures that would suggest that it's more likely to be an evolving trading range.
But also, yes, absolutely. And here again, we're going from a downtrend environment into a trading range environment. Something should happen right here, some kind of change. How are we calling that?
That would be the price failing to continue to go upwards. In other words, the automatic rally being limited by a price level which defines the resistance.
Okay, so that's great. That's also another great point. So automatic rally will define an area of the resistance. I'm sorry, the level of the resistance, and then sell-in climax will define the level of the support. And we would be thinking that the price should consolidate around the mean in this area and be contained. Majority of the price should be contained within these two levels, and it is. So that's great. The question that I'm also asking is that switch between the downtrend to a consolidating environment. When we look at the rally, even the automatic rally itself, and we could see even going into the upthrust right here in potential phase B. Is this the largest rally that we've seen so far? On the way down.
No, on the way down, this is the third such rally and that we have seen so far.
I'm not sure about that. So if this is the high of this move to the downside, right? So we have rally number one, we have rally number two. There are quite a few here, so all of this too. And then look at this rally right here.
Yeah.
Is this the largest rally out of all of the rallies that I've identified here?
Right.
Yes.
I would agree. Yeah.
Yes. So the rally has increased.
Right.
The distance of the rally has increased, and that produced some kind of change.
That's a change of character, yeah.
Yes, yes. So this is where I'm kind of like trying to go with you here. So a change of character. Now we need to confirm it. How do we confirm it? Well, we look at the climactic run, and we are comparing it to the next rally that comes after the change of character rally.
Right. The next decline that takes place.
Yeah, the next decline. And then we see that, again, the distance is diminishing. We're seeing how the spread might be diminishing as well. We're having a higher low right here in this area. So that confirms that change of character. And the change of character is going to be all about, well, something different happens here in comparison to this or this. Every time we either have a very weak rally and then a break to the downside. Weak rally and then a break to the downside. Here we have a much better rally. So something is different. And then we don't have the next break to the downside. Or even in some instances, we might have a small break and then the price will come back into the trading
range.
Yeah. So this is a change of character. This is where everything changes for the downtrend, and we might expect a trading range. And it's always going to be associated on the way in with phase A. Yes. Yeah. Excellent. Okay, so now that we know where phase A is, and by the way, another, for those of you who are more advanced, you might have a question here, and I'm actually very surprised that nobody's asking it right now. Automatic rally and automatic rally. Could it be that we could have, this type of labeling? And I'd say that I would be totally okay with this, right? So, because we have more of this rally and this secondary test that is more of the function of the selling climax itself, and then just a continuation of this rally to the upside. I could label this as an upthrust action right here in phase B, but you could also label this as a much larger automatic rally, and then your secondary test is going to be somewhere here in this area, and this could be your phase A. Now, the biggest question here is, well, what does it mean? I mean, like, it looks like so discretionary, but the biggest question here is not actually about the labeling. My biggest question to you, all of you guys at this point, is, does it really matter to your trading how you label phase A?
No.
Why?
Because we are just looking at the pattern as it is evolving, the patterns, the nature and the pattern of the rallies and the declines.
Where will you be trading, Rama?
I would be trading at the phase C or D as the trading range, as the price gets out of the trading range and the new trend emerges. That's where I would be trading.
So somewhere here in this area, maybe even more, maybe like somewhere here in this whole area. Why? Because it's always going to be to the right of the trading range where we're going to originate our trades.
Right.
So does it really matter how we labeled phase A? I
No.
see I see a lot of this kind of like this mental, resistance. I have
Yeah.
to label everything correctly. You have to trade everything correctly. You don't have to label everything correctly. I'm going to go even further with this statement. You have to trade correctly. You don't have to analyze everything correctly. And that is counterintuitive because
Yeah.
we always think that by making a good analysis that will lead to a good trade. Not necessarily. Sometimes my bad analysis leads me to much better trade than the trade that I've analyzed, a lot. Why is this happening? Well, because, markets are unpredictable, and the only thing that you could really control is just your actions. So if I see some kind of mistake, analytical mistake that I've made, and the market shows to me right away that you are wrong in your analysis, I could mentally make a switch and say, I was wrong. If I was wrong, what is the correct interpretation? Well, it's different. Could I take a trade on that? Yes, I'm still in that zone where I could take a trade on that. So therefore, you could use it like this, like this mental path. Okay, so let's assume that we're gonna go with the original phase A, selling climax, automatic rally, secondary test. Then I already mentioned upthrust action in phase B. So Rama, let me ask you this question. What is
Hmm.
the next point in this trading range that attracts your attention that you could identify right away and you can say, I know what this is? The most obvious thing.
And the most obvious thing is a, a deeper secondary test that occurs um, in November, which is essentially very close to the support level, and
Mhm.
the behavior of the price when it reaches that level.
Okay, so what is it? How would we label it?
I would label
Secondary
that
test?
as yes, ST, yeah,
Okay, great. And there are, by the way, multiple secondary tests.
in
And
phase B. Yeah.
this is also, guys, another thing that I want you to start thinking about. And today I'm going to give you so much material. For those of you who emailed me and you guys said, I watched the video and it was like an eye-opening watching it for the second or third time. And some of you watched multiple times. And I do believe it because going through this, even through this chart, I already gave you probably like a dozens of concepts that you could make a note of. So for those of you who have time, watch the recording again, make the notes, send those notes to me. You're gonna receive so much value out of that exercise. Okay, so what am I talking about here? We have to understand the texture of the large formation, how it forms. We could see that the selling climax is always going to be associated with the secondary test, the retest of that. And then in phase B, Rama has mentioned, this secondary test that goes to the support level. But there are quite a lot of those tests around this area. There are 1, 2, 3, 4, 5 tests, maybe even 6 tests. And you kind of could see from the texture of the price that it's all together. It's not just separate tests. It's the testing um, that takes some time and produces a trading range. So when we look into this, we usually would be thinking that it should belong to one phase. In some instances, we would break this, but in this case, it seems like it should be one test and then one phase. So what phase would it be? All this secondary tests here.
Phase B.
Phase B. Yes, we
Yeah.
still need to experience phase B, and we know that phase B is going to be the largest among 3 phases, A, B, and C. Okay, so if this is phase B, then what is the next most obvious thing that you see in this trading range that you could identify and tell us, I know what this is?
Uh, would be there are 2 points I can identify. One is the upthrust that happens soon after the testing of the support level, and the other one is the the low of the phase C. Those
Okay.
are the two things that stand out.
Okay, so let's deal with phase C first. So why is this phase C?
The price action and the price again, unlike the other test in phase B, the price gets much closer, and the spread of the bar narrows, and the rally that follows that for the first time traverses through the trading range, commits itself above the resistance level,
Mm.
and then stays above that resistance level.
Well, someone has been doing a lot of homework and watching a lot of videos. So Rama, good job. So Rama is giving us a lot of thoughts on how we could identify phase C. I'm going to show you this slide, and in a couple of other slides that we have to cover first, on how could we identify phase C. This is going to be one of the major kind of shortcuts that I'm going to give you guys. So phase C is going to be associated with the number 3 or last test at the level of the support. So where is the first test? Well, naturally, after the climactic action in phase A, that's number 1, and that's at the support level, even though it comes so high, but it's still testing the local stopping action by selling climax. Test number 2, naturally, will happen in phase B. And this test number 2 is just too complex because there is a selling climax, there is a whole formation with a selling climax, automatic rally, secondary test, phase A, phase B, even this phase B upthrust, phase C. So it has its own trading range. So it's just a complex trading range and a complex process of testing that we are observing here. But this is a test number 2. And then phase C always will be a test number 3 at the level of the support. That's very important because test number 4 is going to be at the level of the resistance that was created by phases A and B. We will come back to this later on. We also know that phase C is going to be the lowest low in the uptrend. And because we look at the chart where we know what has happened before, where did uptrend has started? One might argue that, well, we had the start maybe like somewhere here in December of 85, and then we have a higher high and a higher low. One might argue, well, maybe even a low prior to that, November. But for us, what's important is to understand is that there is still a trading range that unfolds. It's a non-trending environment. So therefore, there is no really trend until it hits the low of phase C, and only then we would be seeing some kind of uptrend. Now, we'll have some other different definitions on this subject where we might have even the low in phase A, and that would, establish the whole trend. But we still would be going through some kind of consolidating accumulative actions, prior to that. So the lowest low, when you look at the historical chart, could define phase C for you really easily. That's where the trend starts. We also will talk about a second point of fear in phase C. So that second point of fear either is going to be associated with the increase in the volume signature where weak hands are going to capitulate, and that's going to produce that lower low. Or we could have, like in this instance, a very big distance to the downside, right? So reaction might increase. And that could produce, increased selling behaviors by weak hands, and they will be trying to get out, and there might be some acceleration around the support here. What else? We also said that there are some characteristics for phase C that we need to understand. We definitely know that the reaction should have some kind of bullish signs. And Rama has mentioned those. The downward spread is diminishing relative to what we've seen, let's say, in phase B or on the climactic run in phase A. We could also see that maybe with this diminishing down spread action, the volume is also diminishing. That could be a possibility as well. And kind of a laborious move to the downside instead of very quick, sign of strength type of move to the downside. So that's the big difference. Okay, so let's come back to our labeling. Phase A, phase C. So everything in between is phase B. And we see two instances where the price overcomes the previous high in a very insignificant way. In the first time it tries to commit to the upside. Actually, first time was here in phase B, so up thrust action in phase B. Then the second time it's just an attempt to commit and then the return. And then the third time there is a commitment and then a return back. So all of those instances are going to be up thrusts. There is only one extra definition here that I want you to know. This rally right here, that looks like a rally in phase D. And some of you who are more advanced are probably just thinking, okay, well, why is he not talking about this? Why is this not a sign of strength rally? Why is it not identified as phase D? Well, look at the next reaction that comes after that. It actually negates almost all of the gains that we've seen on this rally. And we've just identified phase C low as the low of this reaction. So therefore, whatever we're observing, all of this moves to the upside are most likely a part of phase B. Now in phase B, we could have upthrust, and some of them are going to be quite significant. The ones that are showing us some bullish activity and that are going to look like a phase D sign of strength could be labeled as upthrust action as a minor sign of strength. Whereas the major sign of strength is still going to come in phase D, right? So we could have a major sign of strength as like this rally, and then a backing up action into the lows of the support that acted before as the resistance. So this could act as a backing up action. So this big rally is going to be a major sign of strength, and then this smaller rally in phase B is going to be an upthrust action as a minor sign of strength. And that's that distinction that I want you guys to give. All right, let me quickly just see what other questions we have. Isn't phase A important for closing of a position, from Philip? Yeah, absolutely. Here at this point, we're going to be facing a lot of trading decisions. I would keep in the position if we are correct on our buys and if we are in this trade. Also, some other decisions, not for those of you who are in this position at this point of time. Let's say somebody is looking at the stock and identifying maybe, some kind of interest in the stock. So in phase A, what kind of trading decision we're going to have at this point? Most likely none, but that's a decision on its own. Not to participate is a decision. Not to be involved, not to get your risk exposure at this point of time is a trading decision. Doing nothing, sitting on your hands, is a trading decision. So those type of decisions are going to be important in phase A. Is there a sign of strength rally after December secondary test? So we've just covered this. Yes, it's a sign of strength rally, but it's a minor sign of strength rally in phase B and not in phase D. Where would you place the trade in phase C? Okay, good question. That comes from Justin. So we're looking at how the price moves to the downside, and we're looking for any points of the reversal, right? So move to the downside, no reversal. Move to the downside, no reversal. Move to the downside, no reversal. Move to the downside, oops, reversal, which would equal our point of entry, and that would be our first point of entry. Our second point of entry could be this bar right here. Our next point of entry will be somewhere in this area where we are experiencing a backing up action. And our fourth point of entry is probably going to be somewhere here on the breakout. This was not the most efficient in this case entry, but still with your stop losses it shouldn't get you out, so all 4 points of entry you should just go through. Okay, what else? Is it reasonable to take a trade to upside in early January considering reaction looks like a backing up action? Yes. And if you're thinking that this is a backing up action, let's say, oh, I see, right here. Okay, got it. Okay, yeah, this is a good question, but again, we're coming back into the point of, how do we actually manage the position, meaning how do we actually come into the position, right? So we need to see some kind of reversal of this initial move to the downside. There is no reversal, so there is no entry, and that would save us from entering prematurely and from exposing ourselves, to the remainder of this reaction. Why is not a backing up action between February and March? This one right here, yeah, it's a backing up action. Again, it's just minor, right? And then this is a backing up action, this whole formation, and it's a major. Right? So quite a lot of distinctions already, guys, that I've given you. So you have to take notes and you have to remember those. All right, Rama, really quickly,
Okay.
let's talk about the distribution. So what is the most obvious thing that you see in this distribution?
In that small area of distribution, the most obvious thing is the price action that almost resembles buying climax, the very first bar.
What are the
And
characteristics of this buy-in climax that we see?
widespread rapid rise of the price to a new high when compared to the previous high.
Climactic run. Mm-hmm.
Right. And then it's immediately followed by an automatic reaction,
Mm-hmm.
and then that is followed by a secondary test which tests the highs of previously established highs.
Please note there are quite a few secondary tests here. The first one is going to be an attempt to retest the buy-in climax. That would conclude phase A. Okay, let's finish with the buy-in climax. What else? Gap up is going to be a part of that, climactic stop in action. Actually, as you look through this intermediate stop in actions, this is a buy-in climax. It's just intermediate. And look how gap is happening here. Look at the move. Look at the gaps here. Also a buy-in climax. Also a buy-in climax on a very, very small scale. But we kind of see that this analog repeats over and over and over again. So yes, a lot of climactic action. And what do you think the volume signature here is?
More likely to be moderately high volume.
Mm-hmm. Okay. Something like this. I wonder why moderately. I'm just really curious.
That's because the extent to which the price has moved when compared to the previous high on the left side around just before June leads me to suspect that the volume might have been only moderately. If it was climactic volume, I would have seen a price go a little bit higher.
Interesting. Okay, guys, for those of you who can, quickly find me the volume signature and maybe send me the picture through the chat or something like this. I'm now really curious. My first thought would be that because the next area is the reaccumulation, the volume signature is going to increase, but probably more locally. That's number one. and we probably would be thinking that that would give us, just an idea that we're going to go into the trading range with the bias that is going to be to the upside. So therefore, not a lot of supply signature should be there. On the second thought, looking at all of these buying climaxes, to the upside, we're seeing that there is a big gap to the upside. So there is some kind of event here that stops this whole movement. So this event should have, an increase in the volume signature for sure. Plus the whole day it just goes up. So that should, have some kind of demand behind it, especially at the high levels over the resistance. So I wonder what the volume signature is. Okay, we'll come back to this. So buying climax, automatic rally, secondary test, our phase A is defined. What is the next phase that could be easily identified right away?
Phase C, again, the price where the price comes and tests the support level, and followed by
Hold on a second. We are discussing a distribution, right? So with the distribution, we're going to have this type of the schematic where phase C is going to be not at the low, but at the high.
Yeah.
So where is it?
It's right at the July level.
Yes.
Which,
the price commits temporarily above the point of the level of the resistance. So how would we label this then? Obviously phase C.
Yeah.
And what is this Wyckoff event? The price commits temporarily above and then comes back into the trading range.
Upthrust.
Upthrust.
Yeah.
Because this is distribution after upthrust after distribution. Everything between phase C and A is going to be phase B. In phase B, we're going to say, okay, there is a little bit small upthrust here in phase B. There is multiple secondary tests. And then as the price goes down, and we see that the price has some tail right here, it's very hard to see. How would we identify this action? Obviously in phase D now.
Mm-hmm.
So this first, at least attempt to commit to the downside, how would we label it?
That would be labeled as a last point of supply.
Okay, so the rally will be a last point of supply, but the move to the downside from the high of the upthrust to the low of this reaction, this whole move right here, that would be what? Think about phase C low and accumulation and move to the upside. The opposite to that, to the downside.
Downside, yeah.
Sign of weakness?
Yeah, sign of weakness, yeah.
Sign of weakness. So it's a little bit condensed here, but here it is. Sign of weakness, LPSY, and then off we go to the downside. Okay, great. So distribution has a very small cause. So therefore, the downtrend should be also small. And we kind of see that. Okay, well then next we look at the reaccumulation range again. Okay, so what is the most obvious thing that catches your eye, Rama?
The most obvious thing is the price leveling off after the sign of weakness and the last point of supply. It establishes a price from which there's a rally that takes place.
Okay, so we're seeing the low that is being created, and then we're seeing a move to the upside. Now, this rally, is this rally much better than the rallies that we've seen in the down move during the down?
Absolutely. Yes, absolutely.
So what does it mean to us? Is this a change of character?
Yeah, change of character.
Change of character. At this point of time, a change of character would suggest that from a downtrend, we're going to go into non-trending environment and we're going to look at the trading range.
Trading range.
The trading range here, again, the questions that we're going to address was the trading range. Bias, timing, character.
Right.
Okay, so and also change of character is going to be associated always on the way into the trading range with phase A. Okay, so if this is phase A, then what kind of phase A Wyckoff events do we have? The stop in action is going to be labeled as how?
Yeah, it it will be labeled as a local selling climax.
Yes, and I like that local definition. Okay, great.
Yeah.
So selling climax, the first rally
That would be automatic reaction.
reaction, and then the next test that's going to test the selling climax is
Selling
going to be
climax.
a secondary
Secondary.
test, and
Yeah.
that would define phase A for us. Okay, so
Yeah.
then what is the next most obvious Wyckoff event that you see here?
A rally that goes above the level of the resistance and doesn't commit itself to the price level above
Mhm.
and declines into the trading range.
So kind of like this type of action, right? Like we have
Right.
this up
Yeah.
thrust and then we come back into the trading range. And it happens
So
at the same spot, right? So right after
yeah.
phase A, so acts a little
Yeah.
bit as an analog, to what
Yeah.
what we're seeing here. So
Right.
we're saying up thrust.
After. Yeah.
At
Yes.
this point of time, looking at this rally, you're looking at the character of this rally. Could we say that maybe this rally acts even as a kind of like a minor sign of strength here?
Yes, I would say so. Yeah.
Yeah, look at the character. The price moves
Yeah.
so quickly to the upside. It commits on actually multiple closes to the upside, actually maybe just one or two. Spend some time there. And this is what's interesting. Sometimes upthrust, look at this upthrust, goes up, commits really quickly, and then by the end of the session already shows some supply, and then the next day comes back into the trading range. This
Right.
one is different. This one has 3 days that goes above the resistance, and then look at the time that it spends, maybe like 2 weeks above
Yeah.
that point of resistance. So what does it tell
Yeah.
us? It tells us that there is some kind of
Yeah.
strength behind the price action.
Strength in the background. Yeah.
Yeah, and that strength, guys, it's not indicative of the timing. By no means think about that, oh my gosh, the strength in early, let's say phase A or early phase B, we should go into this position. No, this trend just suggests to you that this is a reaccumulation, but it doesn't suggest to you the timing. The phase analysis is going to suggest to you the timing as to when we should go into this position. But this strength suggests that the bias could be to the upside. So now you're just looking for the confirmation of this information. Is it really that the bias is to the upside? Because we're just still too early. We're in early phase B at this point of time. Okay, great. So what's next? If this is, by the way, if this is biased to the upside, we would say that this is an upthrust action rather than an upthrust. Okay, well then, what's the next thing that catches your eye?
Right. The next thing that catches my eye is the disconfirmation. That is, up until this time, the strength of the rally and the commitment of the price to the level above the resistance for a few days uh, tilts my bias to the upside. But on that bias, I always look for to see if that is going to be confirmed by the subsequent price action. In this case, the subsequent price action is indicative of weakness. So it comes down,
You have
price
to give the.
declines,
Okay, so we're talking about this.
right, right.
Okay.
And then it comes and produces another secondary test.
Okay. Well, let's kind of grab this idea here from Rama. So he's saying that to come back into the trading range, which we would expect, by the way, in phase B.
Right,
We've tested. This is a secondary test. It's still in phase A, and this is the first test in phase B. This is the test at the level of the resistance, and we should have a test in phase B at the level of the support as well. Phase B is going to test both. resistance,
right.
and the
And
support. And we
right.
see in how Rama has described that there is some supply or increase of the supply that we see in the spread, in the downward spread, that suggests what? That suggests that if supply is increasing, we need some kind of retest of that supply. And usually, the more supply we have, the more testing we need to be doing. And the more testing we need to be doing, that would suggest that we might go in some kind of trading range. So and we're already in the trading range here. We're just kind of like thinking that it's going to prolong the trading range. Okay, well, if we had one test, which was an supposedly, upthrust action test at the resistance, then the next test is going to be at the support. So how would we label this test in phase B?
I would still label that as a secondary test.
Yeah, secondary test. We are not overcoming the low that was created in phase A, so this is a higher low. So therefore, the higher low in phase B would be labeled as a secondary test at the
Yeah.
level of the support. And then a lower low in phase B would be labeled as a secondary test as a minor sign of weakness. Okay, so this is a secondary test, but which one? There are quite a few here. I'm looking at this, I'm
Uh,
looking at this, I'm looking at this, I'm looking at this, I'm looking at this.
I would say the second one, the one year marked uh, where the price reaches the lowest point among that cluster of
Okay,
tests.
got it. So Rama is saying that this point right here is our secondary test. I would probably have an argument here with you, Rama, because
Yeah.
look into this area again. How did we approach it? We approached the whole formation as three tests in different phases. And
Right.
that's what I want you guys to start practicing. I want your eyes and your minds to see this. There are formations that are together, and I'm going to highlight this. Here is a formation where there is an action and then there is a test. There is another formation where there is an action and there is multiple tests of this action. And then there is a third formation that is an action and multiple tests after that. So I want you to start thinking in these terms because we will be defining the texture of the whole trading range as, the construction of, smaller pieces that come together. And locally, when we say locally, then we mean that this test is local to the selling climax, or these multiple tests are local to the climactic action that Rama has identified here. Or maybe these tests are local to, the initial selling climax that we have here. Okay, Rama, do you see that?
Yeah.
Okay, so maybe something, to kind of like work
So,
with the next homework, just,
abs-
identifying those
yeah.
areas.
Yeah.
Different textures, but different tests, but, they all create the same structure. Okay, so if we're talking about different, textures and structures within the logic structure, then as we've identified tests here and identified the phases there, then I could say that if this is test number one is going to be associated with phase A. This whole thing is test number 2 associated with phase B. Then this is going to be associated with
C.
C. Okay, and that's how how simple it is for us to think about this. Uh, even though it's such complex structures that we see, in test number 2 and number 3, but they all actions around the same area, right? They are all the tests of the action that we see prior, to testing area. Okay, so if this is the case, then let's relabel this. Phase A Then phase B probably goes to what? To this point right here, right?
Yes. Yeah. Yeah.
And then phase C is gonna either be concluded here or it's gonna be concluded here. So we have two scenarios here. Okay, so how would we, let's say, is there any other labeling that we need to do here? Where is our phase D?
Um, I would consider the second C you have put there as D, more D rather than C,
Okay,
and I would consider the first C to be the real phase C because of the signs of strength I see. It's
right.
making higher lows,
Hmm.
and that to me is the
Hmm.
beginning of the new uptrend.
Great.
And
Okay. Okay, yeah, I like that. At the same time, I would say that there are probably two ways of how we could label this. So let's say phase D labeling at this point. Okay, so two ways. The first one is exactly what Rama is describing. We are in phase C here, in the smaller formation. Then look at how a rally is committing to the upside over the what seems to be an apex formation. And we know that in the apex formation, the sign of strength is actually not going to be very good. It's not going to be extremely distinct. But what it's going to show out of the place of uncertainty, right, where both buyers and sellers are inactive. They just waiting for new information to arrive, either to act on the bias, or maybe to add to the bias, or maybe to close the bias that they have. So at this point of time, a small sign of strength suggests that there is a little bit more buyers, and their supply is exhausted at this point. So we could move the price much easier. So a sign of strength in the apex formation is always going to be that small thing, and then the backing up action comes exactly on the second reactionary leg to the downslope in the resistance. So that acts as a backing up action, and therefore this is phase D. So this is what we have: apex, and then a sign of strength that is going to be just a little bit small. And then the second label in here, which is also acceptable, is going to be more about a much larger phase D, right? So we could say that this move to the upside that overcomes the upthrust action and the buying climax of the distribution formation is a major sign of strength, and by definition the price goes through the trading range, commits to the upside, and look at the commitment, so many closes above, so this is a really good commitment to the upside, spends some time in there, and then reacts exactly to the area of the support that acted before as the resistance. So therefore we could see a major sign of strength with the major backing up action, and then we would identify this as a minor sign of strength. So that labeling is also acceptable. Please note that for trading purposes, again, it doesn't really matter. Why? Well, because if you're identifying this as your potential phase D, then your position in reaccumulation is going to be most likely the first position is going to be opened in phase C. Your second position is going to be, and third, your second, third, and fourth position are all going to be here. So from 1 to 4, all of this is going to be a very active zone for you to act on. And then after the major sign of strength and the major backing up action, that's number 5 that you would be thinking of opening. So from that perspective, doesn't really matter. You will still be operating in this space. You still will be a buyer here. All right, Rama, really good start. I definitely feel a lot of kind of like knowledge that is already there.
Mhm.
So a lot of, I also hear a lot of correct semantics that are associated with this course.
Mhm.
So So a lot of things. So just continue. And for you specifically, I would say nuances, details are going to be extremely important, right?
Okay.
So just, absorb all of this knowledge and just make notes and, concentrate on those details.
Yeah.
All right, great. Thank you.
Thank you.
I'm sorry, Ram, I muted you. Okay. All right, let's quickly look at that question that we had. And thank you, Lee, for sending this chart. That was really quick and cool. And sometimes I'm going to request you guys. I don't want to be distracted, but you guys could definitely quickly find what I'm looking for and email me. So we were looking at this spread, and we said that most likely the volume signature is going to increase here. Why? Well, look at the gap. That's number one. So that usually is some kind of event, probably, well, definitely overnight event, where institutions have not produced so much excitement before. Like any other gaps that we see on the way up, they are much smaller, right? And this is not a gap. And then this is a huge gap. And the huge gap is always going to be associated with more interest from institutions, and we see a continuation to the upside. And actually, I forgot to mention that this change of character bar most likely is going to have also a very high volume signature just because of the function of the supply that came on the buying climax itself. So that was a really good call. And then also, this is going to be one of these exercises that I'm going to give you guys in the practical when you're going to graduate to more advanced level. One of the things that we practice in the practicum course is reading the volume signature of the price and reading price signature of the volume. What it does, it kind of opens up the new dimension of understanding as to what do we expect the volume on the price to be on the specific bar, whether it's the price or the volume bar. And that's exactly what I did here, just kind of like deducing as to what kind of volume signature could be at this contextual place with this particular bar. All right, great. Let's look at some questions really quick. What is the difference between labeling secondary test after the selling climax or labeling a shakeout, reaccumulation versus shakeout schematic? Okay, yeah. So this was the question here. Selling climax, automatic rally. Could we possibly label this as a shakeout? Yeah, we can. Usually, the shakeout in the reaccumulation is something where we have the buying climax, and then we have some kind of shakeout right away. We don't have it here. We have a buying climax, and then we have an area of the distribution. And that usually suggests, the distribution usually suggests what? That there's going to be some kind of downtrend that's going to come. And downtrend is going to be concluded with the stop in action, which is going to be labeled by us as a selling climax. So my preference in this particular case would be just to label this as a selling climax and extend the boundaries, from the selling climax and from the automatic reaction or automatic rally, rather. And then in the reaccumulation structures where we have a very quick move to the downside without a lot of the distributional activity, you could say like, okay, this could be interpreted as a shakeout action. I will keep this in mind and I will point this maybe on other slides. Okay, next one. If we were in September, and I'm assuming what, September, where? This September, and this question comes from Philip, or this September. Okay, so probably this one right here. So if we were in September, wouldn't we interpret the rally as a phase D with backing up action right before September. This one right here. Okay, and the backing up action to what? To which range? To this one? So a backing up action should be coming back to the formation, right? To the original formation. So we have, for instance, we could say that here we have a minor backing up action, and it's a part of this formation. Then we have a larger backing up action, major backing up action, and it's a part still of this whole formation. Uh, uh, you know, if we would have some kind of, formation that would be something like this, where we're seeing that maybe this whole move is a sign of strength, and then this is a backing up action that has its own trading range, then probably yes, we could do this. I think it's less obvious in this case, Philip, so I probably would be just thinking that it's just a trading range on its own. It's a reaccumulation. We had an accumulation range, a move up, and now we are just in the reaccumulation. Okay, but good clarifying question there. Is it common that one can identify phases of the larger range with smaller local ranges within that larger range? Yeah, we could definitely do this. One of the things, again, to do is that, texture analysis, right? So if you could instantly see that there are smaller ranges here that could be labeled, by the way. I mean, look at this. Sell and climax, automatic rally, secondary test, phase A, B, B, C, sign of strength, backing up action, or LPS, major sign of strength, major backing up action. Sell and climax, automatic rally, secondary test, phase A, B, B, C, sign of strength, shakeout type of action in D, LPS, here we go. This one, selling climax, automatic rally, secondary test, phase A, B, C, LPS, and so on and so forth. So you could see how you could label even smaller structures. And again, we could label this structure right here. We could label this structure right here, this structure right here, this structure right here. Everywhere there are trading ranges. If you just get this concept that you look at the markets through the prism of different structures, whether it's a trend or non-trend, whether it's at the higher, larger time frame, like a large formation, or a smaller formation, like this 3 that I've shown you. By the way, here is another range. Here is another range, right? So all of those are just ranges between the swings of the trading range. If you can understand this concept and it kind of becomes natural to you, you will start looking at the market in a different way. And usually, during the first months, I receive a lot of emails from students that just say like, oh my gosh, I look at the markets, I look at the chart, and all I see is just all of those formations. And it's so much easier for me now to interpret the market action, through those formations. So hopefully we'll get to this point. All right. Okay, what else? Okay, so a comment from Doug. Actually, preliminary supply in May, and then buy-in climax in July. So, what are we looking at? This preliminary supply, Doug. Is this the one? Is this the formation that we look at? And buy-in climax in July, like this? Was that your interpretation, Doug? To the right for this is the preliminary supply. This. Okay. Great. Okay, so Doug is suggesting, what about this type of labeling, right? So buy-in climax, then obviously We could go with either sell-in climax, or we could go this whole thing with the automatic reaction and then secondary test. This could be phase A, and then let's say phase B, and then phase C. On the level of trading, because we will be trading here, that doesn't really matter. And if you label it like that, that's fine. Where I have the problem with this labeling is these 2 points right here. So I'm going to redo this a little bit, and then you'll see what I mean. So let's say that we're still in the automatic reaction secondary test, phase A, and then it goes into phase B and phase C. This doesn't really matter to us. But what comes before? When we put, let's say, a buy-in climax right here as this point, we're basically neglecting the fact that the buy-in climax characteristics happened before that. And we went through those. A gap, acceleration to the upside, climactic run, acceleration of momentum, extreme volume signature, which just basically screams at you and tells you that if it stops on this climactic volume, then most likely this is a buy-in climax. So it's the character that does not allow us to say that this is a buy-in climax. So therefore, the second point here is that it has its own formation. So what is the bias of this formation? The bias of this formation is the distribution, so therefore we would be labeling this as an upthrust in phase C. So therefore the preliminary supply is going to come somewhere here. So that's the only thing that I would redo. But everything else, again, for trading purposes, you could say that this whole thing is the buy-in climax. So sometimes I would say buy-in climax trading range. What does it mean? This means some kind of distribution, local formation that would take us down. But you know, I would probably not identify this necessarily as a buy-in climax. So this whole thing, you could say a buy-in climax trading range. All right, great. Thank you, Doug. And what else? I thought that in phase D, I should search for biggest rally of the whole range starting from the support level. So the part of the first phase C should be in phase D, so from Philip. So we're talking about this spot. Okay, so yes, when we look at the horizontal range, we're looking at the sign of strength and the backing up action as our change of character confirmation. And usually the sign of strength rally will be the largest rally in this whole trading range. And that's in the horizontal formation like this, right? In the apex formation, where there is a lot of inactivity by market participants, as small a sign of strength could be that timing mechanism that defines a change of character. So we would be looking at all of the rallies that occur after the last point where supply has increased or supply has produced some kind of downward result that was exceeding the result to the downside before. And we see that the rally there, this rally, is basically the best rally that we see in this formation. So it's a little bit of a nuance. We'll talk about this later on, but I'm so happy that you guys are seeing this, that you're asking the correct questions. Because if you're asking the correct question, this means that the logic that we explained before was also good, and we just did not cover this. So that's great. All right, so really good exercise. All right. Okay, so with each of these slides for the homework, I'm going to give you guys my interpretation, and you could go through this as a homework and just observe all of the labeling that I've done here. In these boxes, gray boxes, I'm identifying changes of character and so on and so forth. So hopefully that's helpful. Now let's talk about phase boundaries. So this is that theoretical slide that we're going to have, and we're talking about accumulation here. So how do we define phase boundaries? It's extremely important for us to understand where we put the boundary. And sometimes it becomes so subjective that as I was receiving so many questions from students, I realized that I need to kind of like, stop all of this discretionary talk as to where we are putting the boundaries, and that just to define exactly where we would put that border between phases. So let's go through this. And we're going to start with something slightly different. The first thing, and this is one of the most important things right now at this point of the course that I want you to remember. I want you to remember by heart the sequence of Wyckoff events throughout all of the phases in accumulation and the distribution. And therefore, I just want you to remember that phase A is going to start with the preliminary support, go into the stop in action by the selling climax, change of character as an automatic rally, and confirmation of that change of character as a secondary test. That secondary test is going to be a local test, and test number 1 to the selling climax. Phase B is going to have in the accumulation either a secondary test at the support level or an upthrust action at the resistance level. So these two are mechanisms of testing. Testing what? Testing both supply and demand at the support and the resistance level. In the instances when the price is going to overcome the resistance, we're going to say that we're looking at the upthrust action. Sometimes I label it as upthrust action, like this, UTA. And then if we're going to have a lower low, then we're going to label it as a secondary test, as a sign of weakness, as a minor sign of weakness, actually. Yeah, some small corrections here are needed. Phase C is going to have either a high low, and we're going to label it as a last point of support, or it's going to have a lower low, and then we will be talking about either a spring or a shakeout. Phase C also could have a test, not necessarily a secondary test, but a local test to a spring or a shakeout. Phase D is going to have last point of support, sign of strength bar, sign of strength rally, and a backing up action. Usually phase D will be discussed mostly around sign of strength rally and the backing up action. A sign of strength bar has been added, to the methodology by me, just for the class purposes. This is the spot where in the middle of the range we're identifying emergence of institutional urgency to buy, to be in this position. And this is one of the points of entry for us in accumulation on the way up. We'll talk about this more. Last point of supports are going to be all of the reactionary lows on the sign of strength rally that present some kind of buying opportunity. Those are going to be short-term weakness situations where we're going to say that the long-term bias is to the upside, but the short-term bias has some kind of weakness, bearish bias behind it, and those are going to be the spots that are going to be associated with establishing or adding to the position. Then we've talked about two changes of character in the reaccumulation. And, originally, again, I've talked about this. Originally, when I was studying Wyckoff method and, Hank was introducing me to this concept, Hank had a concept of the change of behavior. He never actually specifically talked about the change of character. So change of behavior was basically identified in late phase B and in phase C and in phase D. And what Hank was talking about is a change in behavior as behavior on the rally could become more bullish, and then behavior on the reactions at some point could become more bullish as well. So for instance, when we look at this chart, and we look, let's say, maybe at this reaction right here. For the first time, reaction creates a higher low. So that's a change of behavior. It's not necessarily a change of structure, because a change of character is a change of structure. But a change of behavior is not necessarily as a change of structure per se, um, where we are confirming the best rally, the sequence between the best rally and the best reaction, right? So here's that sequence, the best rally and then the best reaction. So here it is throughout this whole range. So that is a change of character, but change of behavior could be just a better rally and then the reaction is still bearish, or usual rally and then a better reaction. So that would be a change of behavior. There are two changes of character that I mentioned. Our first change of character is going to be associated with phase in, with phase A. So it's the change of character into the trading range, and it's going to be defined as the rally between a selling climax and automatic rally, and it's going to be confirmed by the secondary test. And then the second change of character is going to be on the way out of the trading range in phase D, and that's going to be a rally between phase C low and sign of strength rally high. So here's the high, here's the low, here's that change of character, and it's being confirmed by the backing up action after that. Phase boundaries. So this is very important. This is something that I was looking at in all of your homeworks today. So let's go through this. How do we define the boundaries? So let's talk about the boundary between phase A and phase B. Well, what do we see? What do we have to see there? So we want to identify a secondary test as the conclusion of phase A. And then it's around this area, this is where we would be looking for the reversal. Once we identify this reversal, this is where we're going to put the boundary between phase A and phase B. So why would we do it like this? Well, obviously we want to include all of the points of phase A, which is preliminary supply, selling climax, automatic rally, secondary test. And then we want to identify the ending of secondary test. And secondary test is just a reaction. So we want to find the reversal of a downswing that acts as a secondary test. And once we find this bar, that's where we're going to put the boundary between phases A and B. We're going to do the same with the boundary between phase C and phase D. And in this case, it's a little bit easier because we do have another test. And that test is also just a downswing. So for this downswing, we're going to look for the reversal. And the reversal bar is going to be our boundary between phases C and D. So it's somewhere here. And then the boundary between phases B and C is and by the way, let's just do phase D as well right away. So kind of the same concept, right? So backing up action is going to be a reaction. So in the reaction, we want to look for the reversal. So here it's a little bit more complex, like it was here as well. So we see the stopping action, and then we see a minor test. So it's out of this minor test that the boundary would occur. We see here a reaction and the test to this reaction. So it's out of the, that test on the reversal of that test. This is where the boundary is going to be created. Now the boundary between phase B and phase C is a little bit more complicated, because basically we need to understand the intention behind phase C, which is what? Which is testing. This is the final test at the support level. So therefore, from this definition, as this is the test, we need to find the place in phase C where there is first attempt to test the support level. And we usually look into phase B lows, and we are saying, okay, where is the first time when the lows of phase B were tested. So somewhere here in this area. So, and we want to put the boundary exactly on this level where the test has happened for phase B. So this is how we define the boundaries for all of the phases. I really, guys, would like you to stop here, stop the recording, make some notes, think about this, maybe take a chart just to go through that, and just to think about how you put in those boundaries. All right, great. Let's go to the next slide. So we are at 10 to 5, so we have still maybe an hour and a half, hour and 10 minutes. All right, so say yes if you would like to volunteer. Who's next? All right, just gonna go with the first one. Philip, you have to unmute yourself. Philip, how you doing?
Hello. Do you hear me?
Yes. Just speak up a little bit.
Okay, sorry.
Yeah, closer to the microphone. Okay, great. All right, am I pronouncing your name correctly, Philip?
Yeah, thank you.
Okay. So let's look at the first trading range. What is catching your eye?
Well, probably this selling climax,
Which is
the
where?
large swings.
So let me just label this for you. Point number 1, point number 2, 3, and 4. Okay, which one is the selling climax?
Number 2. The first would be the preliminary support, I think.
Okay, so let's start with this preliminary support selling climax. So let's go through the logic of this labeling. So we know that selling climax has to be the stop in action, right? And then after the stop in action, what should happen next?
Automatic rally.
Next is going to be automatic rally. And automatic rally is going to be associated with what else? With what kind of change of behavior, change of character? I'm kind of giving it out to you, right? So a change of character,
change
right?
of character. Yeah.
Change of character. So a change of character is going to look like what? Why is it called a change of character? What would we see on this rally that is going to be so different than what we've seen before?
Well, maybe a bigger price swing than in the rally before, and
So,
maybe a little bit bigger volume.
okay, great. And specifically, maybe in this case, because this is an accumulation after the downtrend, demand signature is going to go up, right? So the distance of the rally could increase, the volume would go up, the demand is going to increase, the up spread is going to increase, right? So where for the first time do we see this type of price action and volume action as well?
Well, maybe between 1 and 2.
Yeah, this first rally, right? From this low to this high.
Yeah.
That looks like that rally that you've just described as a change of character. Why is that? Well, the distance for the rally has increased, right? Looking at the previous attempts to rally, where is it? Well, here's one, here's another one, and this is the high, of that downswing. So this is the largest reaction to the upside. Look at the spread; it's increasing as well. What can we say about the volume signature, by the way, Philip? Just looking at the spread itself, what do you think the volume is doing here?
Oh, well, increasing, hopefully.
Okay, and why do you think it's increasing?
Well, because it looked like there was a fight between where the ending price will be and before, like the difference between the range of the tick and of the wicks and the ending prices, I think.
Yes, absolutely. We see, and what is this fight? How would we call this fight? It's the fight of volatility, right? So there is a climactic run to the downside that increases the supply tremendously. I mean, we're seeing how it's a general capitulation here. It's not institutional, it's not public capitulation. Everyone is capitulating here. There is a gap to the downside, big spread to the downside. The first initial momentum is to the downside. So this day on the intraday level is going to look like this. Previous close, maybe open, I'm sorry, open is going to be at the low here. So this is open. And then momentum is going to carry us down first. That's going to be my first initial assumption. Then we're going to have the rally, and then it's going to carry us to the close of the previous day. So that's how the action would look like. So supply has increased, then demand has increased, and then supply has increased again. So there is a lot of volatility during this intraday action, which brings basically the volume signature increase and then most likely some kind of spike on that day. So therefore, a fight between the buyers and sellers creates volatility, which volatility and volume is just, so connected together. And increase in the volume is just, suggests that there is an increase in potential increase in volatility. Okay, great. So if this is a change of character, then where is our selling climax and automatic rally?
Okay, well, so the selling climax should be the lowest point of this.
Okay.
Yeah.
Automatic rally, and then the next move to the downside is going to be what?
Secondary test.
Secondary test. Could the secondary test be a low?
Yes, it could be.
Yes, it could be. It could be a high low. It could be at the same level. It could be a low. The key is, if this is a low, does the price come back into the trading range or not? Because if it doesn't, then it's not a stopping action. It's just a continuation of the downtrend. We could have a low for the secondary test. Yeah. Okay, great. So this concludes phase A. What's the intention behind phase A?
The change of character.
Yes, the change of character, and to stop the downtrend from going further down, right? So stop in the trend and then change the character with which the price unfolds. Okay, phase A. And then what catches your eye next?
Well, the two wicks which are at the bottom of the range. Yeah, the 2 and the 3.
Okay, so kind of like quite a few tests here, right? So smaller test, bigger test. So if we would be talking about test, the magnitude of test, probably we would say secondary test number 1, that was a local test, to selling climax. Test to selling climax. And then these two tests look like the same magnitude, but they are diminishing in size, which basically tells us that 2 and 3 in the downward distance that is diminishing is a bullish sign. And then look how high they are relative to the selling climax and relative to anything in phase A. So that's an almost like extra bullish sign that we have. So that's all about bias. Okay, so that's great. But then how would we label those, two tests?
Yeah, well, I would have trouble distinguishing which will be the tests in C, but I think it should be the...
Go ahead.
It should be the last one.
And why?
Because,
what's the logic? I mean, this is the correct answer, but what's the logic behind it?
Well, if in any trading range there should be like 3 major tests, so and we have no test after the 3, so the last one has to be the test in C.
Yeah, and this is again, third test is going to be our phase C. Second test is going to be phase B. So if this is third test, this is from where the trend should start. And even though there is already a definition of the higher highs, higher lows, this is the conventional TA definition of the uptrend. You could argue with me that we're already in the uptrend here. Yes, we are, but we're still in the consolidating formation. It's just upsloping. then if this is a consolidation and it's just upslope information, then we need to identify phase C. So Philip is talking about the test, so this is great. Looks like phase C. How else could we check that this and confirm that this is phase C? Well, what happens next? Where is the actual uptrend that doesn't have the same type of the reactions that in the trading range? It's in this area right here. So here is our kind of like pure uptrend that we were looking for. So if this is an uptrend, then the low that precedes that uptrend, it should be phase C. And it does.
Yeah.
So that's great. Another confirmation that we could have is after phase C, Philip, what should happen? Which phase?
Phase D.
Phase D. And phase D is going to be associated with the major sign of strength and with the major backing up action, right? So we could say that in this case, and I forgot who was asking me about that backing up action, that could it be, much larger? Well, in this case, if we would extend the resistance level, we could see how this formation is resting on the resistance level that is being projected, as an upsloping resistance. So yes, this is a major backing up action that has its own trading range. Now, let's quickly talk about alternative labeling here. You could label this as phase A, and then I've seen that some of you said, okay, this is a test in phase B, and then this is a phase C. Phase B is still the largest among three, so that actually is good. Then you have a sign of strength in D and a backing up action. Now, I'm totally okay with this labeling. Why? Because if you would be thinking that this is an accumulation and your goal is going to be to establish a high probability trade, which is going to be not in phase C, but in phase D, then you kind of open the position at the same time as the trader who would label it as phase C and would try, to on the elements of strength just to get in phase D on the way up. So for trading purposes, it doesn't really matter. But I want you guys to kind of understand and see that we have to have first test, second test, third test, that the trend is going to start at the low, so phase C, and so on and so forth. So there are quite a few things here that I would be thinking that this labeling is probably better. All right, Philippe, what about the second trading range? What is the most obvious thing on this consolidation?
So the first 2 points, which defines the trading range, probably.
Okay, so I see it like as these 2 points. What is the first point? How would we label it?
Buying climax.
Okay, why is this a buying climax?
Well, because it's the end of the uptrend. But I do not see and there is a gap between the last bullish take. So maybe that's one indicator.
Okay, so gap. What else? What about the spread increase? Right. Look at how the price moves prior to that, and look at this bar right here. Something is different the way how it moves now. So
faster.
Much faster. So momentum increase, velocity increase, spread increase, gap to the upside, and then it stops. It's a stopping action. So all of these elements are elements of the climactic action, in this case, a buying climax. Okay, well, what's interesting is the next reaction, right? So we see that there's really not a lot of reaction, that's number one. Secondly, there is really, after the climactic run, there is no trading range that would define some kind of causality for the price to move down, and that's why the move down is just so small. This, by the way, is just a preliminary supply, this range right here. And it's in these cases where we could say that because there is not a lot of distributional activity here at the buying climax itself, we could label this move to the downside as a shakeout first. Or we could label it, so this will be more alternative labeling. And then a more conventional will be just a regular automatic reaction. So whatever you guys did, that's fine. The only thing here is if you're labeling this as a shakeout or a selling climax, then the next rally is going to be labeled how, Philip?
Automatic reaction.
Rally, okay, and then secondary test, and that would be your phase A. Okay, in the alternative label, in the more conventional labeling, right? So you'll have bind climax, automatic reaction, and then the secondary test, and that would conclude your phase A. And that would be the only difference. And I want you guys to see this. We've studied this in the previous class. I gave you the slides on the reaccumulation. Some of the reaccumulation are going to have the structure where they're going to have a distribution range, and we've seen this in the previous slide. Then the price goes down, so you're going to have a selling climax, and then your labeling is going to be the same. And then in another formation where you have a buy-in climax and then you have just a sharp reaction that defines the boundary of the range, then you could, in some instances, say that this is a shakeout, and then you kind of start it over as just a regular accumulation. So this will be an alternative labeling, and buy-in climax, automatic reaction, secondary test, this would be conventional. Please take notes of this, because this question repeats itself. All right. Well, Philip, how would you like to label it? Okay, buy-in climax. Then let's just go with the conventional. Automatic reaction, secondary test, phase A. Okay, so then what is the next thing that catches your eye?
Yeah, and now I'm not sure, because if the secondary test is the test to the upside, I'm not sure what's the decline to the
But what
support
catches
level.
your eye? Instead of thinking what comes next and the problem associated with the labeling there, what is catching your eye? And by that I mean, are there any extremes or extreme behaviors that you see in this trading range that catches your eye?
Yeah, the nice rally from the top to the bottom of the support.
Okay, let's come back to this later on. What else?
Yeah, and then this rally. I thought the decline from the secondary test to the bottom of the range. Yeah, this one.
Okay, what about it?
There's the first thing, and yeah, then the last time that happened again.
Okay. Well, when I'm
It's
asking
September.
you guys this question, what catches your eye? Obviously, I'm trying for you to identify either extreme behavior or just extremes, right? So what are the extremes? The extreme,
The signs of support
yeah,
of strength.
the extremes are going to be all this, right? So these are the extremes. So like for instance, this extreme right here, this rally off the low. What do you think this rally is?
I'm not sure.
Okay, that's fine. So we see what happens after this rally. We have some kind of backing up action and then a continuation to the upside, right? So we are in the uptrend environment right here. So we are leaving the trading range and then we are going into the uptrend. Yeah, there is another formation here. But what phase would we be doing this, and what kind of Wyckoff events would, conclude the trading range in this manner?
It's probably spring.
Where?
From the the beginning of the uptrend.
Give me a timestamp. Which month?
September.
Okay, so this one right here?
Yeah.
Okay, yeah. So at the low, we probably have a spring. Why is this a spring, by the way?
Because it's from the support level, and it goes right at the through the whole trading range and with increasing speed.
Okay, but then also a spring is gonna be a lower low, right? A spring is gonna be a temporary either attempt or commitment. below the support. That's how we would look at the sprint, and that's the definition of the sprint. So look at this, guys, how this bar is trying to commit to the downside on the intraday basis, does not commit, only has a tail here on the daily, and then returns quickly back into the trading range. So it's an upthrust only reversed, in reverse. And then it has some kind of local test here. Okay, great. So which phase is going to have a sprint in it?
The beginning, it's in phase C.
Phase C, absolutely. Okay, so if this is phase C, then everything in between phase A and phase C is phase B. We want to check that phase B is the largest among the three. This is where the cause is being created. This is where supply and demand are interacting with the very, very volatile, events and behaviors, right? So, okay, let's come back to phase B really quickly. The test at the support level, how would we label that in phase B?
Secondary test.
Secondary test, yeah. And then the high that overcomes previous resistance point in phase B is going to be
sign of strength.
An upthrust action.
Upthrust action.
As a minor sign of strength. And the reason why we're saying a minor sign of strength is because the price commits significantly to the upside. It doesn't just commits a little bit. It just commits quite significantly. Look at the three closes above, and then the price spends so much time above here before it actually commits, below. So that's why a minor sign of strength. Not every rally in phase B are going to have characteristics of a minor sign of strength. This is going to be more of the exception rather than a norm. Okay, great. So then,
can I just quickly ask you, if I have a buying climax which is tested by the secondary test, the first one, so the secondary test is to the upside, can I also mark as secondary test something that tests the support level, like in the different direction?
Yeah, and that was kind of like my biggest issue with the labeling that I've seen in the reaccumulation, where basically this sequence does not make a lot of sense to me. I would rather sequence this in a different way. I would rather say buying climax and then shakeout type of action, and then just say automatic rally and then secondary test. But sometimes it doesn't work like this. There is not really enough room for phase B, and then we could see that from the behaviors. What is this rally? It is a test. It is a test of the climactic action right there. So I started in the conventional way. I started thinking that, okay, so test at the resistance, test at the support, and phase B is going to be like that. We also could label even this upthrust right here as a secondary test. Actually, this whole upthrust action in phase B has been added, in this course. We've never used it before. Upthrust always has been associated with three things. Usually it has been associated with the distribution, and Hank kind of was always on me about this, like adding something new to the methodology, but it made sense to me to do that. So upthrust was associated first with the upthrust in phase B of the distribution, and then upthrust after distribution in phase C. It also was associated with the upward thrust in the uptrend. And we would use this as a momentum tool, where the momentum increases or decreases on the rally. So when I realized that this upthrust right here has the same type of action as just the regular upthrust in distribution, it made sense to label this as an upthrust action rather than an upthrust itself. I'm going to have a slide for you on this. I think David Weiss, Gary Follett, Gary Dayton a much better with identification of those upthrust actions everywhere. And sometimes when I listen to them or I conduct sessions with them together, it just kind of amazes me how they see this. So there is a lot of value in that type of work, in that type of knowledge, and I would highly recommend for those of you who are not familiar with the names that I've pronounced, go check them out. I'm actually extremely open to cooperation with all of the Wyckoff teachers. For those of you guys who are not new, you guys know that I've conducted so many classes with all three of them. And obviously I like to teach with other teachers, with other people. All right, so let's conclude this really quick. So after phase C, the rally up is going to be what? This rally.
The spring.
With spring is always going to be a lower low at the support. It's not going to be a rally. And by the way, I've seen, guys, that some of you would put like phase C somewhere here or like a part of the rally. No, phase C intention. What is the intention, Philip, for phase C?
It establishes the new trend and change the character.
It's the final test. Final test of supply at the support level. That's what phase C is all about. So it cannot be a rally. Phase C is basically a test. Phase C is not the rally. So for those of you who are kind of mistakenly thinking that phase C could be a part of the rally, no. Phase C is the test, and the test only comes in the accumulation as a reaction and not as a rally. Okay, so we concluded the sprint. What is the rally that comes after the sprint in phase D?
Maybe another upthrust action. I'm sure. Sorry.
Quick help here. Write it down, guys. What is this rally after phase C and phase D? A sign of strength. That's correct. A major sign of strength. Okay, and then the reaction after that is going to be a backing up action. Correct as well. So that would conclude phase D, but we have a much bigger formation here. So look at how one formation is on the top of another. So we are seeing here a sell-in climax as a stop-in action in their regional range. Then we see a buy-in climax as a stop-in action for the reaccumulation. And then we're seeing another formation, which is reaccumulation as well. And it starts also with the buy-in climax, but on the higher magnitude level, that was a major sign of strength that we've just discussed. So this whole formation here is just basically a major backing up action that starts with the buy-in climax, with the stop-in action, and then what would be the first reaction? How would we label this, Philip? If this
automatic reaction.
Automatic reaction. Okay, the next rally.
Secondary test.
Secondary test concludes our phase A. Okay. Look at the character with which this rally and this reaction moves. How would we label those? Is this the best rally so far in this smaller trading range?
Yeah, it is.
So when would we experience the best rally in the trading range that commits above the resistance, sustains that progress, stays above, and then comes exactly to the support level which acted before as a resistance?
I'm sorry, I'm not sure what you are asking.
Oh, okay. So look at how the spread here on this rally, right, increasing.
Mm-hmm.
So it's much better than what we've seen before. Here, here, right? So this is the best rally in the trading range. We know that the best rally in the trading range probably is going to be associated with the change of character, especially on the way out. And a change of character on the way out is going to happen in which phase?
In phase D.
In phase D. And phase D is going to be associated with which Wyckoff points?
Sign of strength, backing up action.
Yes, those are the main two.
Last point. Yep.
Yes, last point of support and also sign of strength bar. Okay, well, we are not concerned about this too, but we definitely want to identify a sign of strength rally and the backing up action. So does it look like a sign of strength rally?
Yes, definitely.
Absolutely. Yeah, the character with which the sign of strength rally occurs is going to be such where the spread to the upside is increasing, the volume signature is increasing, and by the definition of the sign of strength, we need a commitment staying above and then backing up exactly to the level of the support. So that's exactly what's happening right there. So this looks like a sign of strength and a backing up action. If this is a sign of strength and backing up action, then the previous low is what?
Is the test in C.
Excellent. C. Then everything in between A and C is B. And then sign of strength rally and a backing up action is our phase D. Okay. And here it is. Here is our labeling for all three trading ranges with the changes of character, with all of these points that we've discussed. Philip, okay, so the main task right now for you individually, personally, is to remember the sequence of all of the Wyckoff events that happen in the trading range. So this is kind of like a very individualized task for you right now. So start with that and then go to the homework, next homework. All right?
Okay, thank you.
Sounds great. All right, good progress. So let me see what kind of questions we have on this slide. Is there any difference between momentum and velocity from Lim? Yeah, there is definitely a big difference between momentum and velocity. This is not something that I want to go in right now. This is more of the advanced studies, and I would probably prefer to talk about this in practicum. But, at the minimum, Lim, you could just even Google definitions on the momentum and velocity, and it doesn't matter that, you're going to get them from like physics, but there is a difference there. But we'll talk about this in a slightly different context later on. It's just a big discussion there. Okay. How can you tell the difference of the first reaccumulation and the second? And what would be that difference, Joe? What do you mean by the difference when you might be looking for a backing up action? Okay. So I think that the biggest problem here with the backing up action is actually somewhat of a not very distinct sign of strength. Because when we look at this area right here, and especially taking this tail, we might say that there is not really a commitment to the upside here. But remember, this already acts as a minor sign of strength. So if the price is going to come to the same level, that's at the minimum already a minor sign of strength. But we have a much better commitment. If the highest commitment was here, then the highest commitment for the second rally is higher. It just definitely shows that there is a not much better commitment, but a better commitment to the upside. Now, the next problem that we have here is the backing up action itself. The backing up action actually looks very normal. There is no increased spread to the downside that we see here, which is great. That tells us that supply is going lower. It actually comes to the level of the buying climax and then stops there and acts as a spring, comes back into the trading range. So everything looks normal. And I would be actually initiating my position right on this bar right here. This would be my last point, my next to last point of entry here, just based on this. The first one is going to be spring itself, reversal of the spring, sign of strength bar, and then you have to stop because of the resistance level. And then the next one is going to be, so this is 1, 2, 3. point number 4, right of the backing up action. So I would be already fully committed into this position based on how the price has developed at this point of time, and it still would be profitable, right? So we're profitable right away. We are profitable throughout this whole formation. Now, what happens here is here we are losing the momentum, and that suggests some kind of reaction. The reaction is actually somewhat healthy. It doesn't prolong for a long time. It doesn't have a big distance to the downside. The spread does not increase significantly, but it's still somewhat different than, let's say, this action right here. It has some gaps to the downside, actually 2 of them. It has some kind of volatility associated with this. So that requires another test. So at this point of time, you know that there's going to be a test of this area. And you might even just say, if there's going to be a test, then if I decide to enter somewhere here, it's going to be inefficient. Why it's going to be inefficient? Well, just because if the test requires time, then it's going to take some time. So therefore, we are waiting for the test of the test. And it comes on the next reaction. We see how different this reaction from the previous one. That's going to be our point of entry number 5. And then from here, I mean, I've talked to Philip, and we identified that the character of this rally is different than anything before in this range. So therefore, a sign of strength. And then the backing up action is kind of shallow. So again, you could add to the position here. You could also add on this bar. So that's number 5. That's number 6. Number 4, 3, 2, 1. And then after that, you're going to be thinking that either this or this is going to be your 7 and 8. So there are quite a few points of entry. And by the way, for those of you who are campaign investors, and by the way, we have quite a lot in this class. So I will be pointing those things out a lot. Campaign points of entry. Look at this. In the original accumulation, you want to enter on the because this is a high or low, this is these are your points of entry here, and then this one. So this is going to be -4, -3, -2, -1. So those are the points of entry that you're going to have in each of the trading ranges. And please note, for the long-term investor, we are campaigning from one trading range to another. Our goal is to establish the position at the correct timing with the correct buys. So here is our regional positions that we're opening, and then open them at the higher prices, the price level, at the point where phase C is happening, and nothing else. And then in the next formation, we're doing the same, phase C, and then all of the other entries in phase D. So every time you scale in and you increase your position size, you are doing this at the higher level, and you're doing this in such a way that defines the timing of when the price leaves the trading range. I mean, obviously, maybe with an exception of this point of entry. The goal for the long-term investor, and the way how I view my long-term campaigns, is to be in the correct stock that is going to have a very prolonged cyclical move to the upside, where I could hold on to this position beyond 1 year. That's number one. That's number one goal. My second goal is to stay in this position until it's done, until this cyclical run is done. So we have to have a significant change of character to define the ending of the campaign. There are certain characteristics to the ending of the campaign that we would be thinking about. And also, when I'm in the correct position for as a long-term campaign position, I want to be aggressive with my next points of entries, because the trend is defined. And now I just know that it's all up to me to define the correct timing on the next stepping stone pre-accumulation range, and to define the correct entry, and to scale in more, to create a substantial position. So when it comes to the conclusion on the climactic run, which is going to be the terminal climactic run, I have a lot of money there built in as unrealized gain, and I'm going to take the profits at that point of time or scale out. So when you're right, be a pig. Don't be scared. And I'm saying be a pig. Obviously, I'm referring to George Soros, and specifically his trade in 1991-92 when he shorted British pound. So I was reading about this trade, and you can get his book, and he talks about this trade. He exposed his fund to 4% of risk on this trade. So, and working with institutional clients, I must say that 4%, for them could be a substantial risk. But George Soros is not a very necessarily kind of like your typical institutional type. He is what I call, and this is very close to me because I trade the same way, more of the concentrated portfolio investor. Whenever he sees opportunity and it works in his favor, he could add to the position and go beyond your regular risk parameters. And that's what I'm suggesting here. If you're at the advanced level and you feel comfortable with all of these concepts and with trading in general, you could be aggressive with at specific spots with the specific stocks, with the specific patterns. This is a pattern right here that could have that type of aggression for us that we could call. All right, great. We'll talk more about this later. As you guys could see, there are quite a few, things that are still ahead. Okay, are several reaccumulation close to each other sign of very strong bullish move yet to come? All of these reaccumulations are almost stacked on top of each other with bias towards upside from Nilesh. Okay, so I might be misinterpreting the name again, mispronouncing. There is a logic in what is being said here, but it's slightly different as to how I would explain this. Our first accumulation range is not necessarily a part of the formation that comes later on, but it has a very logical, continuation of why we have so many trading ranges after the original accumulation. So think about the original accumulation. What is happening here? Why is this accumulation, why is this range has this type of structure where we're seeing higher highs and higher lows? What do you guys think? What does this represent? And what kind of behavior by institutions could be observed through this type of structure? Okay, now let's just saying urgency to buy, lots of value, CO establishing a position from Joe. Yes, all three are correct. And I would concentrate on the first two. Because it's an extreme oversold condition that creates extreme value proposition for institutions, and this extreme value proposition, both long-term and short-term, that's what creates that urgent buy, which we've seen a lot, by the way, lately with the way how the market has been behaving. And in some of the cases, you see a lot of oversold, conditions. And from that oversold condition, I mean, like you take a stock like Apple or, other leadership type of stocks, and then they decline so much in such a short period of time, but they still within the secular structure of their campaign. So how do you think institutions are going to look at this? Think about their fundamental macro perspective. If a macro money manager thinks that the markets are still, they are short-term vulnerable and weak, but they present an opportunity within the secular uptrend structure, then he or she is going to come in and just buy whatever the selection is available to them based on the parameters of their system. and that's going to be their call. The fundamental money managers are going to do the same. They're going to see some value in the stock like Apple, you know, and they could say that I'm just based on the fundamentals, I see the value, so I'm just going to come in and buy. So this extreme oversold, extreme value proposition here creates urgency to buy, you know, at the lows and throughout all of the rallies. And that's why, you know, this urgent buying creates this type of structure. So then think about what happens next. Let's say that the CO bought the position that they needed at this point of time. Because supply drastically went down, the price goes up at this point. And I would even argue that this move to the upside, and you could go and find this chart, but this is my assumption here, just looking at how the price moves and looking at that CO has established this position. CO is inactive on this rally. And I doubt that, you know, institutional trend following hands, you know, also are extremely active. They might be active more at the beginning of the rally, but then everything else is kind of diminishes as we see momentum going down, the spread decreasing, more laborious move to the upside. So we're probably seeing that demand is going down, and then the volume signature in general is going to be lower than in this area right here. So as they are in the position and they have some profit, what do? Well, they might come in on some points of the volatility and, you know, add to the position, but it's not necessarily going to be a very extreme, you know, big position that they're going to establish. I would see even more that maybe on the rally like this, we're going to see a lot of increase of the demand signature, and that's going to be some kind of value or trend following type of institution that's going to create this type of the position, and they're just going to say, wow, this has confirmed the trend. So and then there is some short-term value that I see here, so I'm going to come in and buy. But the way how they're buying, they're not buying just one day. They could be buying multiple days, multiple weeks. So that's what creates this rally. So this is just a buying wave in the middle of the trading range by some of the institutions, because again, short-term value and long-term value still, and long-term buys. And then imagine that CO got in right here, and then value a proposition for some of the institutions at these two spots, maybe somewhere here. Then the rest of this move is just going to have this signature where we're going to still see some consistent signature of the decline, right? So something like this, and then decline, decline, decline. So you're going to have some pockets of volume increase throughout this whole slide here, but generally, your highest volume signature is going to be here. This is the area where out of the oversold condition, there was so much buying by institutions, and then it's just going to go down. And it's going to go down like this. And then just different pockets where locally the volume signature is going to increase. So CO bought here, and then CO is inactive. And that's unfortunately not exactly how we were taught. We were taught that CO is operating in each of the trading ranges, and this is not true. Once they establish the position, you know, and they just go to other stocks and establish positions there. They might add on the way up, but not necessarily. It's going to be more a function of other institutions seeing, you know, establishment of the trend, some short-term value, and then definitely, you know, just going through this whole thing. All right, sounds good. What else? Why are you calling the event last point of support in phase C instead of this spring right here? So this is a higher low, so definitely going to be a last point of support. You could call this an attempt to spring, but look at this bar right here. So comes down, comes below the support, so it's still a higher low. So that's why. We could also be calling a spring something that would go below more of the local support, so maybe something like this, then we could say that this is a sprint relative to this low and still a higher low or last point of support relative to this low. Okay, good question. All right, so let's see where we are. So we have like, what, 20 minutes or so. All right, so let's talk about identification of phase C. How do we identify phase C? We kind of went through this, and this is just the shortcuts that, again, I've created for myself and for my students. This is not necessarily in the methodology, and that's why, you know, students started calling these Romanisms. So I'm okay with this, and kind of like, when I say that this is a Romanism, so you instantly should be thinking, you know, not in the method, something that, you know, kind of like more proprietary to this course, but still it's going to be based on the ideas of Wyckoff ideas. So I've talked about 3 tests at the support level, right? So the first test is going to be a local test of the climactic action. Second test in phase B of the lows of the selling climax and the secondary test. So in phase B, we're basically testing the previous tests. In phase C, at the support level, this is the last test, the final test of the supply at that support level. And then our test number 4 is going to be a backing up action. And it kind of is logical to me that the initial tests are going to be at the support level, and then the last test is going to be at the next value zone. So they've observed the supply at the lows. That pushes the price up into the new highs. In this case, not necessarily new highs, but new highs relative to the highs in phases A and B. So kind of like in the same zone. As it comes back to this area, we are going to experience some kind of mean reversion trade by professionals that's going to bring us to the increased supply signature, change of character of the backing up action, and therefore we're going to have some kind of tests there. So a test is the test number 4 at this level, that we would say that it's going to be a backup action in phase D, and it's being confirmed. It confirms the change of character, the conclusion of the formation of the change of character, and then once the resumption of this test happens, then we're going to continue with the uptrend. Another identification of phase C that is very valuable to us is the second point of fear. So points of fear are all going to be discussed within the context of the sentiment. Our first sentiment, bearish sentiment that we could find is going to, and therefore the first point of fear is going to be in phase A. It's going to be associated with the selling climax. Why is this point of fear develops this way? Well, I think I've mentioned this many times. You know, we are experiencing a capitulation by weak hands. And in this instance, it's more of a terminal capitulation. And therefore, I sometimes call it a general capitulation that would have both institutions and public behind this capitulation. And what is a capitulation? It's just basically panic. People at this point of time are experiencing a lot of emotional pain because of the losses, and they can't withstand this pain anymore, and they're giving up on their positions, and they're saying, get me out at any point of price, time, but just get me out. I cannot bear this anymore. So therefore, this type of activity is going to be associated with a lot of selling, and a lot of selling is going to produce technical characteristics as increase in the momentum, increase in the velocity, increase in the down spread, increase in the distance to the downside that we see, increase in the volume signature, and specifically increase in the supply signature by weak hands, and increase of the demand signature by strong hands. So first point of fear. The second point of fear is not necessarily going to be in phase B. It could be in phase C. Why is that? Well, think about the sentiment of weak hands. They just sold here and then the price went up. What do you think they feel at this point? This is definitely a regret that they have. So what are they going to do? They're going to buy. If they're regretful that they didn't buy, they didn't hold on to this, and the price went up like this, they're going to buy here, and they're going to buy here, and they're going to buy somewhere here. Now, as the price goes down in phase B into another test, what do you think they're going to do now? They're probably going to say, well, I gave up my position on the selling climax, and that was a mistake. So this time, I'm going to hold on to this position. Have you guys done this? Well, I definitely have done this before. So I'm just happy I'm not doing this anymore, but that was the sentiment. That's how, we trade when we are amateurs. We trade on our behaviors, on our emotions. We cannot control those yet. So they're holding on to this position, and when the price goes down, they're still saying it will go up. And as it goes up, what do they feel? They feel happiness, right? So they feel happy because the price goes by, and they're saying that was a good decision to buy here, hold on to the stock, and now the price is back almost into the same area, and they feel happy. So they're holding on to the position, and they might be even adding to the position, maybe somewhere at this spot right here. So imagine what happens next when the price gaps down and has some kind of, or goes down just a little bit. What do you think they're going to experience then? I mean, they've been through this ups and downs, emotional ups and downs, up to the phase C point, and they are so exhausted. They are extremely exhausted emotionally. And they're just saying at this point, when the price goes down into phase C low, they're saying like, get me out. And this time they make a promise. What is that promise, by the way, guys? Could you think of one? Well, that promise is to never trade this stock again. Or at least for the time being. It's an emotional withdrawal from emotional pain that is based on just inexperience, no knowledge, no skill. And unfortunately, that's how weak hands and, that's their pattern, that's their cycle. They will go to the next stock and they will experience the same things over and over. It could be a different contextual interpretation of the sentiment of how it happens, but basically, on the very primal level of how we experience emotions, it's going to be the same. So that's why this is going to be the second time where they're going to, weak hands are going to capitulate. Now, this is going to be a less of capitulation just because, and it's going to be more public capitulation than institutional. Why? Because institutional weak hands, they are much better learners. They are much more adaptive, because if they don't adapt quicker, they're going to lose their job, they're going to lose their salaries. Money management is based on the performance matrix. So if you don't perform, you don't get the money, you don't get the salary, you don't have a job. So it's much stricter there than with the public. So therefore, the institutions hopefully learn much faster, at least what I see, working with them and working with the public retail traders. So therefore, the second point of fear is going to be more associated with public than with institutions. And if that's the case, usually the volume signature on this is going to increase locally of phase B, but it's going to decrease relative to phase A low relative to selling climax, where we have both institutions and public capitulating at the same time. And that's a very small nuance, but it's a very, very big point. Because if you could see this logic through the chart, and you could understand that with the public capitulating here going into phase C, and we're seeing that on the technical picture, the price goes down, but then quickly comes back. You might be thinking this is the last time when public capitulates, and where institutions, the last time at the support level, are actually buying a meaningful position, and they add into the position that they've already had. Therefore, this last public supply is observed at this level, and therefore what's going to happen after that? There is only one thing: the price will go up. As supply has been observed at the support level, those last pieces on last public capitulation into phase C, that absorption leads to the rise, to the sign of strength, and then this is where mean reversion trades happen. So it's kind of funny, at some point when you understand, the mechanics of it as to what happens next with weak hands. They said, never, never, never will I get into this position again, into the stock. And they are missing this whole rally right here. And once it overcomes and it becomes a CNBC item, and everybody's screaming, it's in the uptrend, they're saying, I gotta go in. So they're establishing the position right here again. And they're saying, I said that I'm not going to go into this position, but this is the time now. And then the first time the price goes down into the backing up action, they are so already conditioned on all of these reactions and all of these, attempts to go up and failure, attempts to go up and failure, attempt to go up, and then the beginning of the failure in their rise. What do you think they're going to do here? They're going to sell their positions, again with the loss, and they're going to say, well, now for sure, I'm not going to go into this position. I should write just, a book for kids about this, just explain to them in such simplistic terms, how the psychology, unfolds. So they're like, I'm selling with the loss, and now I'm not going to go into this position. And they are missing the whole trend. So now imagine if this is a distribution somewhere here, really quickly, and then we'll stop maybe here. If this is a distribution, they, on the way up, they're like, what did I do? Why did I close this position? And then as they go into the next consolidation, which is the distribution, and they see a change of character, so they're seeing what? They're seeing reaction, which creates value for them, short-term value, and I'm talking about weak hands. In this case, not just public, but institutions as well. So, and they're saying like, I gotta go in and buy. So they are buying here. On the secondary test, they feel great. On the next reaction to the downside, they're saying, I made this stupid mistake here at the original accumulation to get out of the position. And every time it was going up after I get out. So I'm going to hold on to this. Okay, well, holding on. And what happens in the distribution? Obviously not what happened with Apple at this time, but I'm just giving you an example here. All right, so they accumulate, the price goes up into the upthrust. This becomes a second point of excitement for them. The first one was on the buying climax. This is where they will be, buyers as well. And they are saying like, this time I'm just going to hold on to this. And as the price goes down into this excitement with them adding to the position, institutions are going to sell, sell, sell on the change of character, sell in phase B, sell on the way down, and then capitulate on the way down. And throughout this whole formation, weak hands are going to hold on, and they're going to capitulate relative to the emotional pain that they have, that they can withstand, and to the knowledge and skill that they have. So some of them are going to capitulate somewhere here, and usually this area is going to be associated with the largest volume signature. And some of them are going to capitulate maybe somewhere here. So depending on, the system for institutions and depending on the emotional pain for the public. Doug is saying, been there, done that, great description. Yes, we all have done that. We all have experienced that pain. This is the reason why you are in this class, or, going through your emails, reading those, and reading who you are as traders right now and who you've been as traders and your inspirations. The majority of students in this class are here for the right reason. You guys are trying to figure out how to make money in the market by having the knowledge, developing the skill, developing the system, and being able to control your own behaviors in a different way than how you've done before or what you're doing right now. And I'm just showing you how you could interpret the chart in such way that would be systematic, logical, and that would elevate your emotional pain because you will know at which points you need to act. You will know at which points you need to get in, to get out, to add, to scale out. It's just going to take some time, but it's going to be valuable. And that's kind of like the message to all of your emails that I've seen today from you guys. All right, I think this is a good point for us to stop, right? So it's almost 6, and let's go through the homework. I'm still going to give you the homework, so let me just do this. Okay, you should not be able to see anything. And, okay, now you should be able to see the homework slide. Okay, so what do we do next? Well, first of all, I would like you to continue with, if you have a lot of time, and there are some of you who told me, I'm here to gain as much knowledge from you as possible. I'm going to do anything, to gain that skill. I'm passionate about this. I have time for this. So for those of you who are like that, so your task is, so I'm going to put this as an optional task. Your task is to watch this session again. Your second task, make notes. Send those to me. Your third task is going to be go through HD homework again, the one that we've covered, and kind of go through your chart and then my labeling and compare. And ask yourself one question. Why? Why did he label it like this? So this type of questioning will bring more questions that we could answer later on. But what it does is it makes you think. One of the things that I'm also noticing, and I'm not saying this about this group in particular or anybody in particular, but we as people tend to lack thinking. We kind of sometimes think that we know everything. That's not the case. I mean, like, I've been teaching this material for quite some time, and even some people that say, yeah, I've taken class and from this and this, I've read these books, I've read these articles, I know the methodology. They come to this class and they feel how much they don't know. And that's just because the market is much more than anything that we've studied, in our lifetime. It's just such a complex pattern. It's such a complex, algorithm and system that we're playing with. So you have to always be, educating yourself. And the best education, I think, going through this course is always asking the question of why. Why is this happening? So that's an extremely important question. So this is for those of you who have time and who want, more assignments, right? But then for everyone else, a very regular assignment is just going to be the same assignment that we've done with Home Depot, but on the distribution. So I'm going to give you the slides with the distributional patterns. You know that this is a distribution, and then you just have to label those. Now, I'm also going to give you some slides on the distribution and Wyckoff phases and the events and the changes of character in the distribution pattern itself. So you will have to kind of like go through those slides, read characteristics, and so on and so forth. But that's the only homework that I want you to do. Watching the recording, again, is optional. I totally understand when somebody emails me and says, well, I've got a 9-to-5 job, it's very demanding, and then I have a family. Guys, I totally hear you. And to those of you who are in this situation, go at your own pace. You don't have to put so much pressure on yourself right away, but just listen to the recordings. That could be one thing to do. Then if you have time, do the homework, send it to me. Then if you have more time, well, then rewatch the recording. But if you can't rewatch the recording, don't worry. Just go through the course this one time. You will have the recordings after the course. Go through the course again by yourself. Or you can sign up for the course again at the alumni rate and then go through the live sessions again with me. A lot of people, actually, a lot of alumni in this class right now. Just because, again, so much material. 3 hours today, and I gave you so much. I probably have given you over 100 concepts. Those small details that you have to go through. So it just takes time. So it's all understandable. So let's look at the slides for this homework. Here's one, Callaway Golf, Netflix, Apple, NASDAQ, Alexion Pharmaceutical, and Yahoo. So Yahoo is going to be your probably Alexion Pharmaceutical and Yahoo are going to be the two hardest charts. Everything else should be quite easy if you follow the schematics. And then I'm going to give you this material, but we will go through this material hopefully next time, but this is something that you should be studying before you do the homework. So the Wyckoff events, the phases, characteristics of those events, something again that I want you to go through to remember, and different schematics on how distribution could unfold. Again, this is something that we will be covering in the next class. All right, guys. Well, that's it for today. Good session. I would be expecting that the next session is going to be as intense as this one. So please be prepared that we're going to go to the third hour, to the end of the third hour, and we're going to finish first the homework on Home Depot. It's still very crucial for us to go through that. And then hopefully next class, but if not, then the class after that, we're going to go through the homework on the distribution. And after that, once we conclude our structural analysis, that's when we're going to switch to supply and demand. All right. I'm going to be expecting your emails with your homeworks. Good job, everybody, with the homework. Really liked it. Good job today with all of the volunteers, and you guys have been writing a lot. So I see a lot of comments. So this is great. This is exactly the way how I want to conduct this class. This is exactly the type of interactivity that I want to have with you. With that, happy trading for this week. I'll see you next Monday. Thank you, guys, and bye-bye.